Rick Waddell was a panelist on the Birmingham Business Journal's Insight into Wealth Management. We thought you'd really enjoy just his answers in video format. We are coming to you from the podcast studio. Rick was recently featured on a Birmingham Business Journal panel titled Insights into Wealth Management. How you doing today, Rick?
I'm doing great, Shannon.
Good. You know, this is a real honor that you were invited to be a part of this panel, and we thought it would be fun to just take the questions and your answers and really share it with everyone out there so they could have a sense as to what you're talking about.
Absolutely. Happy to do it.
So we're going to jump right into it. So the very first question that they asked you as a part of this panel is, it's been a wild ride in the market over the past year. What are some of the best practices for wealth management in a turbulent market?
One of the number one questions that I get is, what are we doing right now, right? Particularly when markets get turbulent, like markets jump up and they jump down and everybody's like, hey, what are we doing? Like, how are you responding to all these short-term changes in the marketplace? And it's a question that everybody wants an answer to because you feel like, things have changed and I need to move. I need to be going over here. I need to be going over there. Like the action in and of itself makes you feel good about it. However, the reality of the situation is that almost everything that you do in response to a short-term market fluctuation or a really sharp movement in the market is usually wrong, right? It usually actually damages your portfolio as opposed to helping it. And I like to use the analogy of prepping if you live in a floodplain, right? The time to prep your house for the flood is not when it started the 3 inches of rain, right? Like it is time to do that long before you get to that point, such that when the 3 inches of rain starts, you really shouldn't be doing anything because you should have done all that prep work prior to this with respect to your portfolio. Turbulent markets are something that happens. We know this, right? You'd have to be a fool to not know this. And so the time to really build your portfolio and build in the defensiveness into your portfolio is not when the markets are turbulent, but when the markets are actually calm. Like, in fact, you should have a portfolio that's built to go through turbulent markets. And in that scenario, actually, the best thing for you to do is not let your emotions sway you about exactly like, oh, I should be jumping in or I should be jumping out, or now's the time to be long oil, or now's the time to be long this, or small caps, large caps, this, that, and the other. It's really much more of just a balanced approach of saying, okay, look, I'm going through a turbulent market period. I set up my portfolio to be designed for this, and let's just let it ride through. Most people, when markets get turbulent and they make like a split-second quick decision, actually do something that harms them long-term rather than hurts them.
We're all going to have to catch up. I'm going to need to finish my coffee to match that level of energy. All right, next question that they posed to you. There's a new administration in Washington. Are there any expected regulatory or tax changes that could shape wealth management decisions? And this is a really important topical question because this is all over the headlines this morning.
It is all over the headlines this morning. And it's one of those things where I try and never invest around stroke of pen risk. Okay. And what I mean by stroke of pen risk is if somebody in Washington or in a state government somewhere or whatever else has to get out a pen and sign something in order for something to happen, that's a really unpredictable thing. Right. So I look at, if we were going to rewind the clock back to 2016, everybody thought Obamacare was going to get repealed. And it didn't, right? We still have Obamacare, right? Everybody thought we were going to get an infrastructure spending bill. We didn't, right? We're sitting here 5 years later and we still don't have an infrastructure spending bill, and we might get one, but we might not. And so making drastic, portfolio changes or this and that and the other with respect to, anticipated policy changes is difficult to do sort of longer term. And so, with a crystal ball, I like to say nobody has a crystal ball with respect to policy. That said, I will say this. With the current administration in Washington, it's highly unlikely that we would see taxes go down. Right? Like it is much more likely that we would see some sort of tax increase, whether that's an income tax increase, whether that's a capital gains tax increase, whether that's a change to the estate tax, whether it's all three. You may want to think about on the margin, the notion in your head of, okay, well, whatever decisions I'm making today, it's likely that my taxes are at least going to be at the same level or maybe be higher a year from now, 2 years from now, 3 years from now. Because with the current administration, I mean, that's just the way that they are geared is, we're going to do a little bit of spending. And if we need to balance the budget, we're going to balance it on the tax side.
I'm going to ask you a question that's not in the official questions posed by the BBJ, only because I think it's really interesting. So particularly as it relates to capital gains possibly being increased, do you foresee people making proactive decisions in their portfolio that could impact the market as a result of either that fear, or is this really more about the administration framing up the argument to have a conversation around where does that capital gains tax land?
I think probably a little bit more the latter, because here's the thing, right? If most of the people that are sitting on large embedded capital gains have done so for a long time with the understanding that, hey, I bought this stock back, 100% ago, right? It's doubled since I bought it. And I don't want to sell it right now because if I sell it, I'm going to be selling effectively 90-cent dollars, right? The government is going to be taking 10 cents of every dollar that I sell, right? If you just do the math on a 50% embedded gain and then 20% of the profits, that's 10% of every dollar you sell. And this is like the Warren Buffett problem, right? Like Warren Buffett is constantly asked, like, why do you still own Coca-Cola? Like, what a boring, worthless stock. No offense, Coca-Cola. And Warren will basically say, well, I bought it so long ago and so cheaply that if I'm going to sell it, my effective sales price is 90 cents or 85 cents or 70 cents or wherever his cost basis is at this point, right? The issue is that if capital gains tax rates go up, that problem just gets worse, right? So if you weren't selling it at a capital gains rate of 20%, I think it's a very hard argument to be like, okay, well, now you should go ahead and take the pain right now because you think capital gains tax might go up in the future. I just don't see people making that decision. I think if anything, a change in the capital gains rate is likely to further embed stocks in portfolios as opposed to generate all this trading frequency in front of it.
Back to the script and to the BBJ's great question. So the next question they posed is thinking long term. What factors should someone consider when looking at the best way to plan for their financial future?
Okay. Now, this is a topic I kind of, to be honest with you, I kind of hate this question because it is literally something that people write books about, like how to plan for your financial future. If you're interested, go to Barnes and Noble. There's a section this wide filled with mostly
talk to your financial advisor.
But like most of the books are boring. Let's be honest. It's okay. But if I were to say kind of three things, I would say this. Okay. The first is the rule of 4 is a thing. Okay. And that's, historically, there's this rule out there in financial planning circles that basically says you can withdraw about 4% of your portfolio a year, plus or minus, keeping up with inflation, and you won't deplete your portfolio. So if you're thinking about like, okay, when I retire at age 65 and I'm going to get, $30,000 a year from Social Security, if I want to be able to live on $70,000 a year as total income, then I need to have like $1 million portfolio when I retire because 4% of $1 million is $40,000, right? So that rule of 4 is a thing. Second rule, compound interest is a thing. Okay. So you want to save early. Okay. When you save, if you can, in your 20s and 30s, you get a lot more bang for your buck because depending on how it's invested, it tends to double. There's a rule of 72 and I won't go into it, but it tends to double every 7 to 10 years, depending on how aggressively you invest, which you can invest pretty aggressively when you're in your 20s and 30s, right? So those savings, if you can put aside 10 grand when you're 20, it's the moral equivalent of putting aside more like 40 grand when you're 40, right? right? So it's very important to start saving early. And if you're getting this message and you're like, well, I'm 40, like your window hasn't passed, you're still better off saving now than you are starting to save when you're 60. So saving early matters, getting those accounts started matters. And the last thing that I would say is, look, small decisions matter. Okay. A lot of people question, like, what's the value of a financial advisor and why would I give this guy, 1.5 or 1% of my money in order to, manage my assets over time? And the reality is that if you make a bad decision about when you take Social Security, or do I borrow to pay for my house, or do I pay cash for my house, or how do I fund my business, or any one of these things, and you make a decision where it's like, oh, well, the after-tax cost to you was 4%, but you could have made, 7% of the market or whatever it is. It doesn't seem like much. It seems like, oh, well, I was giving away 2 or 3% of my money. What does that matter? Well, in the context of 30 or 40 years over which you're saving and planning, it's huge. It's absolutely massive. And so working with a financial planner is not necessarily about making the big decisions, right? It's not necessarily about like, oh, like, should I retire or not? Like, yeah, you should retire, right? Like, should I save for retirement or not? Of course you should save for retirement. Where the real rubber meets the road is around things like, okay, well, when I think about like financing a car versus buying a car, or I think about buying a house, or how do I fund my business, or when do I take a 401k, debt management, all of these types of things, like that's where it's like, you're saving 1% here, 2% here, 3% here, and it doesn't seem like much money, but when you get 30 years out, it's a massive amount of money.
Topic near and dear to my heart. What are some of the hottest trends in wealth management that clients should be aware of?
Okay, so first let's start with the structure of the question, right? Which is hottest trends in wealth management. That's a little bit, it's only exciting to a couple of narrow people like me. And so, honestly, for the rest of the world, it's a little bit like watching paint dry, but that's okay. Probably the biggest thing in wealth management right now is environmental, social, and governance investing, or ESG investing. And this is really for investors that want to invest their values, right? So, if you're interested in not only creating a financial legacy for yourself, but also creating a social legacy for yourself, these types of portfolios enable you to say, look, I want to invest, but I don't want to invest in tobacco companies. I want to invest, but I don't necessarily want to invest in petrochemical companies or companies that have a huge carbon footprint, or, any one of these other things. And they're not for everybody, right? So, there are certain people that are out there that are like, look, it's legal. I don't care. I don't have a moral or ethical issue with what these companies are doing. But for the people that do care about it, they care about it a whole lot. And I would say that, 4 or 5 years ago, these portfolios were kind of very fringy. It was not something that everybody offered. You may have to go to a specialized firm to try and find these types of things. Now, these ESG portfolios are very much mainstream. Almost every major investment company offers some form of it. We certainly offer a form of it. And so if you're interested in ESG investing, it's something that I'd encourage you to talk to your advisor about.
And it's particularly relevant to younger investors. The next gen is very focused on ESG, and the data has really borne that out as we've seen massive inflows into these ESG portfolios. So it's a great next gen conversation.
That's exactly right.
All right, last question from the BBJ. What are some of the under the radar wealth management considerations that represent opportunities or challenges for clients?
So I think probably one of the biggest things that we see over time, and it'll relate a little bit to what we talked about before in the like, what are we doing conversation, right? Is trading frequency and portfolio turnover, right? So I will get this question all the time from folks who are like, geez, like, I feel like we should be trading a lot. I feel like we should be turning our portfolio over. We should be nimble. We should be jumping around. And the reality of the situation is that you get to spend after-tax returns, not post-tax. Sorry, after-tax returns, not pre-tax returns, right? And so everybody, goes through and they think to themselves, hey, what was my headline number, right? Like what was that headline, top IRR? And they rarely start to think about and consider like, okay, but what was the 1099 that I got attached to that with cap gains, short-term and long-term and everything else? And some of these higher frequency trading models where it looks like, the portfolio manager is doing something all the time. When you do something all the time, you basically take every gain that you've got and crystallize it as a short-term gain as opposed to a long-term gain or as opposed to just an unrealized gain. And so it's one of those things that when you think about, particularly for, obviously for non-qualified accounts, it's a very important consideration when you think about picking an asset manager and thinking about an asset strategy is, okay, what does that turnover in the portfolio look like? Because we've seen a number of examples where the top line return maybe even look worse, right? But depending on how much of a gain you had to recognize to get there, the bottom line returns look a heck of a lot better.
There's a real problem of window dressing here.
Yes, there is, and you put a little bit finer point on it than I do, but yes, you can get some of these individuals that are like, I'm trading in and out of the market all the time, and I'm doing this and I'm doing that, and blah blah blah, and you get this 14% year-end return, but then you get a tax bill for 4% of it, right? And the advisor gets to say, I did 14% and the market did 10, and in reality, that 400 basis points alpha just got eaten up in unnecessary taxes. Yeah. So, yeah.
Great panel. I'm sure you were definitely the smartest one there.
You're too kind. Too kind. I'm sure that's not the case.
Well, you're our chief investment officer, so we get to be, boastful of you. But thanks for joining us today.
Hey, thank you.